Gold prices steady just below the $1,400 mark today, surrendering early gains as investors grew jittery ahead of a US ADP employment report to come out later in the day. The monthly payrolls data is closely watched by gold traders as the Fed Reserve has linked the extension of QE to the health of the US jobs market. Gold also stayed under pressure from concerns that demand in India will be hurt by fresh moves from the RBI to curb gold imports. And the Brent crude prices rose towards $104 per barrel on the back of a decline in fuel stockpiles in the US. Investors are also eyeing the dollar that is under pressure, anticipating any disappointment in the upcoming US jobs reports. Volatility in the US currency has been keeping commodity prices on the edge as investors eye any chances of the Fed Reserve rolling back its stimulus. US gasoline stockpiles also fell about 1.5 million barrels this week. And joining us now for a global opinion is Han Pinsey, head of commodity research at Standard Chartered. Han, where do you really see pricing as far as the copper as a metal is concerned, because it's a key indicator of manufacturing cycle, and also given that the economic growth concerns remain as far as the most large economies are concerned?
Well, we think copper prices will hover around the current level into the third quarter before gaining some strength in the fourth quarter. If you look at demand and supply balances into 2014, we could actually see some tightening in the copper market. Now, that's not a consensus view. However, there are risks to additional new supply that's going to come on stream. The market is optimistic in terms of new supply coming on stream. We think there's still a little bit of risk surrounding that. So in the longer term, we think copper prices would be slightly stronger. However, we don't think it'll be hitting around the $9,000 per ton level that we have seen previously.
What's your view on crude oil prices? They've also remained pretty subdued past few weeks. Also, what reason do you assign for them to remain suppressed?
Well, crude prices fell essentially close to the middle of April when China's macroeconomic data wasn't exactly encouraging. Since then, it had been trading between the 100 to 105 range. We think in the very near term, that is probably the range it will be maintained in. However, if you look at demand and supply balances, I think this year we are pretty much balanced in terms of increasing new supply coming from non-OPEC countries, especially the US, of course, being balanced by outages in some other oil-producing countries. And of course, we are seeing the incremental demand coming through that's been expected because of the economic growth. So in short, we think that through the second half of the year, we should see oil prices going higher. I would expect better economic data in the second half to push up and be supportive of oil prices.
Han, what kind of positions, in your view, are large commodity-based funds globally making in the last few weeks, especially because the metals continue to trade weak and crude oil prices also remain low?
Well, if you look at the investor flow information, most commodity ETF have seen outflows, probably with the exception of oil, which we have seen quite a good increase in inflows. However, for other commodity ETFs, for example gold, for example agricultural ETFs, the outflows had been persistent since the beginning of the second quarter. And I think this trend could continue in the near term. And if we look at the CFTC data, we are seeing NASDAQ position going lower, essentially over the last couple of weeks. And again, that signals that probably the bears are still dominant currently in this market.
And what's your view on gold prices then, especially in the short to medium term?
Well, I think gold, we are probably in a cyclical bear market for gold in a secular bull market. I think over the longer term, the trend is still generally up. However, in the near term, we do see a little bit of resistance around the 1500 level. In the near term, there will be concerns of when the Fed will be pulling off or at least reducing their QE program. We are seeing, however, on the other hand, additional liquidity being added into the system by countries like Japan, and going forward we might see more coming from Europe, etc. But in the near term, I think gold prices will be essentially range bound, and we could see resistance around the 1500 level.
And finally, where do you see iron ore pricing in the near term and also in the longer term, given that the Chinese steel demand remains low?
We think that iron ore prices will probably weaken in the third quarter before rebounding in the fourth quarter. A few reasons for that. First, into June, we are seeing the weaker part of the seasonality for iron ore. I think steel mills will start to slow down their production a little bit. Henceforth, the demand for iron ore will be weaker, probably in quarter 3 versus quarter 2. Now, if we look at the supply side of the equation, in the past 4 months, we have actually seen a little bit of tightness in the iron ore seaborne markets. However, that has changed. Now, Western Australia is ramping up their production, and we are seeing Brazil output having a recovery. Henceforth, we will see the supply balance being less tight in terms of the supply side of the equation, and that should again put pressure on prices a little bit. But over in the fourth quarter, we believe that the recovery or rather improvement in the Chinese economy would spur an interest in restocking iron ore, simply because of the overhanging capacity for the steel mills. They will tend to overreact in terms of the production, and henceforth we think prices will rebound in the fourth quarter.
All right, Hans, we'll let you go on that. Thanks a lot for joining us on the show this evening. Let's bring the discussion back to our studios then. Vijay Bambani from BSPL India and Vibhu Ratandhara from Bonanza Portfolios joins us on the show. Vijay, I'd like to take your opinion on gold prices. As Hans was also indicating earlier, his opinion is that gold prices are in a structural bear phase right now. You look at the long-term pricing trends as well closely. What's your view? And also, before this sharp correction which came about a couple of weeks back, before that nobody really could see it coming?
Ajay, as far as I'm concerned, since end of November, I've been talking about laying off purchasing gold in the leverage space, and I've been favoring silver for the simple reason that the government had been making noises about wanting to come down on imports and also domestic consumption of gold, especially household savings, by way of coming out with either gold bonds or alternate investment schemes backed by gold. So there was a clear indication that the largest consumer of gold where household savings is concerned, the nation that we call India, is basically coming down on consumption and imports of gold. That itself was telling you that if not a price erosion, at least shrinking in the speculative premium was in the works. So to the savvy trader, to the long-term investor, it was basically clear that there would be sluggishness ahead. Although the magnitude of the fall may have caught many by surprise, but I think a whole lot of savvy players were anticipating either consolidation or some amount of declines. As far as the medium-term outlook is concerned, I think gold will continue to remain sluggish. Barring technical pullbacks, I don't see a very sharp rebound in gold which would sustain. If there is a sharp rebound in gold, there will be a whole lot of weak hands who've got trapped at lower levels coming out to exit from long positions, either when they hit their break-even points or to a point where losses become more palatable and digestible. So my guess is up moves in gold is likely to be calibrated by overhead supply which will come in. I think relatively speaking, silver is much better poised. There is no overhang of central bank selling. There is no overhang of fear that economies which are distressed will be forced to sell by the European Central Bank rather than being bailed out as the noises emanating from the EU space is coming out. So my guess is going forward, I think delivery buyers of silver on declines are likely to do much better than delivery buyers of gold.
Right. Talking of pullbacks, Vibhu, you have a buy call as far as gold contract is concerned. What kind of targets are we talking about?
I think in the short run, we are expecting somewhere around 27,300 to 400 rupee hit in the domestic market, or I can say in the international market, we might see somewhere around 14.10 to 15 $14.15 in the short while. The reason behind very simple, we are heading towards the ADP data today, or I can say non-farm payroll data in the coming Friday. This might be slightly lower than what it was expected earlier. So we might see some bounce back in the gold prices, particularly in the bullion prices also. So for the short run, I can say for the day or 2 or 3, we might go along with a target of somewhere around 27,300 to 400.
And like Vijay, you also seem to be bullish on silver also as a trading play right now. What's your strategy on the silver, Vibhu?
I think silver on the same, we can say for the very short run, I can say for the day or 2, we might get somewhere around, I can say 44,600 to 44,800 level also. The very good support level for this short-term move is, I can say somewhere around 43,350 to 42,950.
Vijay, how are you looking at trading crude oil in the near term?
Ajay, this is a fairly strong technical pullback alone. I have talked about 53.50 and then 5400 as being points of inflection of resistance here. I think closer to 53.50, one can start looking at opportunities to short sell if you're a high risk appetite trader. Comfort level is obviously shorting close to 5400. I don't expect crude to go past 5400 in a kind of a unilateral move without any significant correction. So if you're going short at 5400, you're likely to get opportunity to basically book profits of 1.5% before the uptrend can possibly gain traction, and I use the word possibly here.
Vibhu, you also have a buy call on June MCX crude, but the target is just about 53.40 to 53.90. That's a pretty narrow one.
Definitely, because we are looking for the crude inventory which is due today 8 o'clock in the Indian time. I think after looking yesterday's inventory from the other agency, the crude stock was fallen by almost 7.5 million barrel, which is quite supportive for the crude prices in the short run. So I can say before European ECB meeting or I can say Bank of England meeting, or I can say before non-farm payroll data, we can take a buy call in the crude for the short run towards somewhere around 53.90 to 5400.